It's certainly been a tumultuous year to say the least, but there have been increasingly positive signs for the law firm market. The Peer Monitor Index is out for the second quarter, and it shows increasing signs of a potential recovery. Joining us today is Bill Joseph, Manager of Enterprise Content for the Thomson Reuters Institute. Bill, thanks so much for joining us today.
Leonard, thanks for having me.
Bill, there are, to say the least, a lot of exciting findings on the legal industry's recovery in the Q2 Peer Monitor report, and there's a lot to unpack here. So before we get into the details, maybe let's start with grounding it a little bit. Let's talk about the Peer Monitor Index. It comes out every quarter, but can you talk a little bit about what the Peer Monitor Index is all about?
Yeah, happy to, Leonard. There's actually a really nice synopsis right on the slide that we're looking at here about what the PMI actually is. And the PMI represents a composite score based on factors that we track through data that we collect from law firms' financial management systems really on a monthly basis, but we look at it for the PMI purposes on a quarterly basis. And we look at a few key factors, including demand, productivity, rates, and expense metrics. And we look at those on a quarter-over-quarter basis, so Q2 of this year compared to Q2 of last year. And then it's run through a formula. That formula then produces this composite score, which in the case of Q2 of this year, you can see skyrocketed up. We actually jumped up to 88, which is the highest we've ever had for a PMI result in a single quarter. It actually went up 22 points from Q1 of this year. So definitely seeing some massive signs of recovery in the legal market as demonstrated through the PMI score here.
All right, Bill. So clearly we've got the major jump in the PMI this quarter. So let's talk about what does that really mean, or what produced such a large increase?
Yeah, well, if we look at the key factors that drive the PMI score, I talked about this just a second ago. You can see these factors that we consider here. And when you look at the factors such as productivity and demand in particular, we're seeing astronomical numbers in Q2 of this year for both of those metrics. And obviously, productivity is by its nature a function of demand. But that's really, we're seeing some fantastic recovery there, driven by growth in some key practices, which we'll look at in just a second.
For those who maybe aren't familiar, what this slide breaks down are the 5 major drivers of firm profitability and hence the Peer Monitor Index: demand, productivity, rates, direct expenses, which is non-partner lawyer compensation, and overhead expenses. You see the figures for how Q2 21 performed versus Q2 a year ago in 2020. And the graph on the right, the orange band represents the 3-year range of how Q2 performed across each of the factors. And the little black triangle there is a reference for where the Q2 2021, this year's figures, fall. And then the black arrow, if it's pointing up or down, shows whether it was up or down from the previous quarter a year, from the same quarter a year ago.
But when we look at these factors, this is how we arrived at that 88 score. We saw really, really strong demand growth, which in turn sparked really strong productivity growth. Rates not growing as strong as they had been. You can see the orange box there that represents sort of the 3-year Q2 range. Last year, we were setting high water marks pretty much every quarter for rates, but there's a lot going into that. As we see rate growth start to cool, that's not necessarily a sign of economic trouble or at this point a sign of aggressive cuts in rates on the part of clients. It's really more of a regression back to norms, if you will. We'll look at that again in just a second here. But the 3.4% rate growth we saw this quarter really overall isn't concerning, because that's still 3.4% growth on top of what had been a really strong Q2 rate growth in Q2 of last year. Direct expenses we see kind of right in the middle of our 3-year range there, but there's a lot driving those direct expenses. And then overhead expenses at their 3-year low. Again, major factors that contribute to that expense growth. But when you add all this up, strong demand, still rate performance still holding its own, and expenses staying well managed in terms of the direct expenses for the most part, and then significantly down in terms of overhead expenses. That's where that number comes from. But one thing to bear in mind about that 84 is the factors that drive that. When we look at this key factor analysis here, these are based on a year-over-year comparison. So it is a function of the baseline that you're talking about. And the Q2 2020 baseline was a very low baseline. That was the first quarter where we felt the full effects of the pandemic shutdowns, and probably one of the quarters where we felt them the worst, because that was when there was all the uncertainty, everything had just shut down. So a lot of these, particularly demand and as a result productivity, really set low water marks in Q2 of last year. And frankly, Q2 and Q3 started to recover a little bit in Q4. So for a good chunk of 2021 here, when we talk about these year-over-year comparisons, we're going to be talking about pretty strong numbers for growth in appearance, but it's really strong growth with an asterisk. And we can look at some of that too in terms of the practice demand areas that are driving these key factor analysis. And we'll unpack a little bit more about what I mean when I say it comes with an asterisk. I certainly don't want to suggest that we're not seeing great things, because we really are. There's a lot of really positive things to look at in these results. And I think that, unpacking a little bit of what's driving that demand and the productivity that results is probably another good place to turn.
All right, so let's start with the top number, demand of 7.3%. What does that number represent? How is it defined? And what was really driving such a strong increase in the second quarter?
Yeah, it's a great question. Demand we define as essentially total billable hours worked, or in law firm parlance, it's basically hours placed into work in progress, or WIP. So there's other metrics that we can look at for hours, but that's sort of how we standardize that metric. And overall demand is a function of what you're seeing on the slide here, where it's sort of that's an aggregation of all these various practice demand categories. And as you look at this, you can see some really incredibly strong practice demand figures. M&A practices, for example, which proportionally are very small. That's what the black band around the outside of any of these given circles represents, is the proportion of total demand that practice represents. So M&A work is proportionally a very small practice, but it grew 17.9% for the quarter, and M&A did a fair chunk to drive the 12.7% that you see there, and what we have labeled as corporate all, which is roughly a quarter, a little bit here or there of the total demand we track, where corporate work came in at 12.7% growth for the quarter. Litigation similarly saw a very strong quarter growth here of 7.7%. Real estate, again, a smaller practice, but up 17.6%. One that I think a lot of people keep waiting to hit and get a little bit more of its stride is labor and employment. But even there, we're up 5.7% compared to this time last year. So overall, these practice demand figures, very, very strong, which is what's driving that 7.3%. But here again, and we'll unpack this a little bit more as we talk further, Leonard, these also have an asterisk to them, right, where we saw a lot of these have low water marks in the same quarter of last year, particularly corporate and litigation work, because everything hit a grinding halt very quickly, particularly early on in Q2, and then it took a while to build back. But the fact that we're seeing this type of recovery in these practice areas is very encouraging.
I mean, certainly the comparisons do become very difficult because Q2 of 2020 was such a rough quarter for firms last year as the pandemic was taking hold. But before we get into some of those details, litigation, which everybody keeps a close eye on, up 7.7% compared with last year. What do you take away from that figure?
Well, I mean, excuse me, that's a difficult one to unpack because there's a lot that goes into that. What we saw as the driving force of the decline in litigation was largely the courts shutting down, being unable to handle matters. We did some analysis in Q2 of last year, looking at really just the month of March in the state of California, sort of Northern California, Southern California, because that was the first state where we saw courts go offline. Or offline is probably the wrong term, considering what I'm going to talk about in just a second. But when we saw courts start to shut down and stop moving matters, and we saw a commensurate and precipitous decline in litigation demand. And as courts across the country started to ripple in their closure, that same type of trend with litigation demand decline really followed across the country. So as we see litigation demand starting to improve, I think that's really a function of a couple of things. That is, courts starting to get their really get their sea legs with their COVID protocols, where they're able to handle matters. We're seeing case dockets start to move again. We're also seeing courts getting much better at operating in an online environment. Courts going to digital and virtual hearings. We've all heard the example of the cat lawyer, which is it has become sort of a running meme. But I think that's an indication of that adaptation of technology that the courts had really been slow to do, and lawyers, frankly, had been kind of loath to push for. They like to be in court. They want to be seen. They want to personalize their clients, and that's harder to do in a virtual environment. But we've seen courts move that direction. So when we see that type of growth in litigation demand, I think it's a function of that, at least partially as well. I would caution, though, that simply because matters are starting to move doesn't necessarily mean that we're going to see a massive uptick in litigation demand. When we look back using, for example, the great financial crisis of the late 20-aughts, if you will, we did see an uptick in both matter volume and litigation demand at that point. But we've also done some analysis within the Thomson Reuters Institute looking at times where litigation demand has grown or case matter volume has grown, and do the two correlate together? And we really haven't been able to draw a straight line between the two. If matter volume increases within the courts, doesn't necessarily correlate to an increase in practice demand at any particular juncture that we can see. So we may be in a situation where matters are going to be moving through the courts more quickly, but that could be a bit of a clearing of the decks where it's matters that may have been settled that would otherwise have been litigated and could have accounted for some hours. Now they're just moving through more for settlement approvals. So it's a large volume of cases, but not necessarily a great number of hours that would go along with those cases. So it's something that we're definitely going to have to keep an eye on as we structure litigation practices going forward, is just how much demand is this volume of cases bringing along with it.
It is complicated, but certainly something everybody's keeping a close watch on, given how significant a practice litigation is. All right, so as you mentioned, the comparisons are complicated. Let's start to break that down and see if we can make some sense of what the numbers really mean.
Yeah, they are complicated, so we can either simplify it or complicate it even further by adding in an additional year, right? So what we've got on the slide here is a comparison of Q2 of 2021 compared to Q2 of 2019. So this is not a compound annual growth figure over 2 years. This is really just a straight up year-over-year comparison, almost pretending as if 2020 didn't happen. And the reason that we're doing this is not because this is how we base our analysis. This is very unique for us to do. We've never done it look like this before. But we're doing this because 2020 was so anomalous, and it created such low benchmarks, or low baselines rather, in some of these metrics. We wanted to see what would these numbers have looked like if we did this type of a comparison. So you can see kind of how we've laid this out, and there's some definitions there in the footnotes. But when you look at this demand at 0.6% 19 or 21 versus 19, we are still seeing demand growth, but not the 7.3% we're seeing 21 versus 20. And that's because 20 was such a low base year. But to be able to say, okay, prior to the pandemic, in 2019, how are we doing relative to that? To see that we're still in positive territory, that's definitely an encouraging thing. I would caution, for anybody who's looking at that 0.6 and saying, boy, that's really terrible. We were at 7.3, now it's at 0.6. What a terrible growth rate number. When we look back at demand on either a yearly or even a quarterly basis, that type of demand growth was not atypical. For most of the 20 teens, we were sort of playing between the 40s, if you will. We were kind of somewhere between minus 1% growth and 1% growth. So plus or minus 1%, kind of in that 2 percentage point range, is largely where we're seeing our demand fall for most of that time period. So to be at 0.6% is kind of right in the range of normal. So in a time frame where we really don't see a whole lot that feels like normal anymore, as discouraging as a 0.6% demand growth might seem, that is very positive to see that type of demand growth. And it's very typical for what we were seeing for demand growth prior to the onset of the pandemic. with the low baselines that came along with it and the stratospheric growth that we're seeing right now.
So if I'm hearing you correctly, Bill, given the tremendous ups and downs we've experienced over the last year or so, to say that, okay, if we go back 2 years ago, compared to 2 years ago, demand being first positive at all and being up 0.6% isn't a bad result at the end of the day.
No, it's actually a very good result. It's something, if we were reporting 0.6% growth on, in a quarterly result, if 0.6% was the demand growth for us in a normal quarter, we'd be saying that's actually very strong demand growth. We'd be happy about that. So I agree with you that 0.6% is a positive result, especially when you consider how low we dipped to be able to come back to not only where we were, but even a little ahead of where we were is very good.
Gotcha. So if we look at the rest of the factors, again, looking back 2 years ago, well before the start of the pandemic, what else can we draw from this, do you think?
Well, the rates growth in particular jumps out, and this is something that I had touched on just a little bit. We saw such tremendous rate growth in Q2 of 20, and really throughout 2020, that when we look at that type of a comparison, we don't have that same trough to dig ourselves out of. We're not talking about the same types of peaks and valleys with rate growth that we saw with demand, for example. You're talking about 3.4% rate growth in Q2 of this year on top of 5.2% rate growth in Q2 of last year. So, and that may seem weird that we go 5.2 and 3.4 and we get up at 8.4. It may seem like the math is off there, but it's because we're talking about percentages that don't necessarily work straight cumulatively. But we're talking about compounding growth, growth on top of growth for those 2 quarters. So that is a really encouraging thing. Clients are wanting to rein in rate growth a little bit. I expect to see some additional pressure placed on rates going forward. And really, when you dig into that Q2 rate growth at 5.2% from last year, that's not to say that lawyers were actually charging 5.2% more per hour than they had been in 2019. When we do that work rate calculation of the rates as you see them here, just definitionally, what we're talking about there is the worked rate or the agreed rate, or to define it, the rate that the client agrees to pay to engage a matter, essentially. That's a function of proportionality, really. Just to kind of illustrate, Leonard, if you and I were in a law firm together, you billed at $10 an hour, I billed at $1 an hour, our average worked rate would be $5.50 an hour. If I didn't bill any hours, our average work rate would jump to $10 an hour. So we would see pretty massive growth in our hourly rate if I simply didn't bill anything. But that wouldn't necessarily put us in better financial standing. And that's not to say that all of the work I had been doing is now suddenly being done by you. It's just a shift in that proportionality. And that's largely what we saw in Q2 of last year, actually throughout 2020, was work was shifting up to higher priced timekeepers. We saw furloughs, layoffs at some firms. Those were felt more heavily by lower cost timekeepers, by associates, paralegals, those types of timekeepers. That shift is starting to come back down now, where work is shifting away from partners, and firms are starting to take better advantage of the leverage that they have. Again, furloughs have been reversed, layoffs have maybe been reversed, and staff's being brought back on. So that proportion is shifting. When you look at it in terms of actual real dollar value growth, partners really didn't charge that much more in 2020 than they did in 2019. Associates didn't charge that much more. It was really just a shift in proportionality. So as we see rate growth appearing to start to cool, much of that really is just due to the fact that lower cost timekeepers are starting to absorb that work again, not that they're able to get that much more or that much less of a rate increase out of their clients.
Sounds good. And then direct expenses up 6.8% compared with 2019. Overhead expenses down 3.6%. What can we make from that?
Yeah, well, the direct expenses, a lot of that is driven by what we have seen somewhat recently here in terms of trends for associate compensation. And this even started back last year, which surprised a lot of folks. We've seen a trend towards seemingly continuously new standards of associate compensation, particularly amongst our largest firms. where what had been an associate scale at 185,000 a year soon became 190, soon became 205, soon became 215. So we've seen that type of increasing associate compensation, not just for first years, but right on up through the lockstep compensation system. So that's been driving a lot of that direct expenditure growth, that type of increase in associate compensation. On the other side of the coin, we saw massive cuts in certain expense areas throughout the course of 2020. And we've continued to see some of those reductions taking hold in 2021 here. So that 3.6% reduction in overhead expenses compared to 2 years ago is driven by sort of a continual cycle. We saw that on the key factor analysis when we were looking at 21 versus 20. We've seen 2 consecutive second quarters here where expenses have been cut fairly significantly. And it'll be interesting to see when that starts to recover. As firms start to return to office, some of that's going to start to rebound. Certain types of expenditures actually have continued to grow throughout the pandemic, some necessarily, some maybe a bit surprisingly. But overall, firms are being pretty cautious with what they're spending in terms of their overhead expenditures. And not that they were being profligate at all in 2019, but just for example, office expenditures have dropped dramatically for law firms, and that's because people aren't in the office. Office expenses are not occupancy expenses. We're not talking about what the real estate costs. We're talking about toner, paper clips, cleaning services, those types of things that make a law office run.
Okay, so when it comes to practice demand versus 19, what do you see as the big takeaways from this?
Yeah, so we look at that key factor slide where we see a 0.6% growth relative to 2019. You can see what's really driving that. Corporate work up dramatically, an 11.2% growth compared to 19. So that's really, really substantial growth. And where we saw for Q2 of 21 versus 20, a lot of that was driven by M&A. Not so much when you look at it on a Q2 versus 19 basis. It's other types of corporate work that are increasing and driving that increase. The reason that we're not seeing a stronger overall increase is that litigation, which is actually our single largest overall practice area, is still down almost a full percentage point at 0.9% relative to 2019. So while we saw good recovery in litigation relative to 2020, we still haven't returned to sort of what was normal, if you will. In Q2 of 2019, we were in the midst of, I want to say it was 8 or 9 quarters of straight litigation demand growth. It started in Q4 of 2017. Actually, so it would be even more than that. From Q4 of 2017 through really even Q1 of 2020, we saw litigation demand grow pretty much across the board. I think there was 1 quarter where litigation demand was flat. Otherwise, litigation demand grew throughout that entire period. Now, we haven't quite reached where we were in that time frame. And I don't know that that's necessarily surprising, because as I said, even if we're freeing up hours and we're clearing the log, or we're freeing up matters rather and clearing the log jam, that doesn't necessarily mean that we're booking a whole lot more hours on some of those matters. So when litigation recovery or litigation demand starts to recover is going to be a very interesting thing. There's a lot of people that speculate that the things that we saw happening in 2020 contractually and just in terms of how businesses were impacted, healthcare, all sorts of things could spark a large demand for litigation. When that's going to hit, how many hours that's actually going to translate into, how much demand, that's really anybody's guess at this point. But when you see that balance between corporate and litigation, that's really sort of why we're coming out at just that 0.6. Because we saw some practices growing over that 2-year period. We saw others that were contracting over that 2-year period. So that's why we sort of see that 0.6. But again, on the whole, that's really a good indicator. This is more of a trend that we've seen in a normal quarter prior to the pandemic. Was we saw some practices growing, some practices contracting, but generally speaking, we were plus or minus 1% in terms of overall demand performance. So that's where we are when we compare to 2020 or 2019.
So to see corporate up by double digits compared to 2 years ago, the last pre-pandemic quarter, and real estate and labor and employment positive, and litigation and tax not too far behind, it sounds like, again, that's not a bad place to be at right now.
No, and obviously we'd like to see litigation stronger. We'd love to see that 0.6% overall demand number higher. But again, had 2020 not happened, if we were not talking about recovering out of that trough, we would be talking about how litigation had kind of a lackluster quarter. But overall, the demand picture was very positive, and there are some really strong indicators, particularly for transactional practices.
All right. And you had mentioned earlier, Bill, about cuts and where firms have been cutting or maybe should or should not be cutting. Now, you mentioned that though a lot of these overhead expenses could also be considered strategic investments.
For sure. And the slide here that we've got up, this illustrates, I think, kind of an interesting dichotomy of one particular type of expense that was cut and cut dramatically versus two other types of expenditures that actually grew during our pandemic period here, where we did not see massive cuts in technology expenditure. In fact, we've seen fairly consistent growth in technology expenses. Same thing with knowledge management. Marketing and biz dev, on the other hand, was one of those areas like office expenses where we saw pretty massive cuts. Some of the marketing and biz dev cuts were the result of reallocation of otherwise budgeted dollars for the sake of covering operating expenses. And a lot of it, frankly, is just there wasn't an opportunity to spend that money. The marketing and biz dev that handled things like partner retreats, client visits, corporate sponsorships, corporate events, those types of things, where those events have not been happening. So there hasn't been an opportunity to spend that money. So that's why we've seen such a large reduction in marketing and biz dev. And there's a ton of conversation going on right now for what's recovery going to look like from a law firm marketing standpoint. I know we within the Thomson Reuters Institute, we're planning our upcoming marketing partner forum for later in the month of August here. That's going to be a huge topic of conversation, not just in terms of what the panelists and the presenters are going to be talking about during sessions, but even what people are going to be talking about over lunch and over cocktails potentially, assuming that we actually be able to do the event in person as we hope. It's just a huge topic of conversation of what are we going to do as marketing and biz dev start to recover. But then you can look at, for example, the ones we've got here, technology and knowledge management that have consistently grown. Some of that was necessary investment, particularly when you look at technology throughout 2020. You had a lot of mid-sized law firms in particular where the technology and infrastructure for remote working simply was not in place. You had people literally running to Best Buy to buy laptops on the scramble. But then you have to do all the setup so that you have the data security, you have cloud technologies, you have access to the necessary case files, making those types of moves. So some of the technology and the knowledge management expense has really been to enable either full-time remote or even hybrid working, as we see a lot of law firms potentially adopting as we move back to a return to office environment. But we're also seeing strategic investments in those spaces. I was actually just speaking with a firm yesterday that talks about how they've really placed a focus on knowledge management as a firm's strategic asset, and trying to look at how do we manage what the firm knows collectively and give our attorneys access to that in a meaningful way that's going to best serve our clients. So you are seeing some expenditures still that are that could really be considered reactionary, but you're also seeing expenses that are being much more strategic. They've sort of gotten their feet wet with changes that firms have maybe felt were necessary for a number of years, but they're now fully committing to it and actually moving forward in a meaningful way. And we're seeing that reflected in some of the expense data here.
So to bring it back to where we started, I think it's difficult to call anything good news these days, given the ongoing challenges and certainly even the tragedy of the pandemic. But it sounds like that there is much to be encouraged and maybe even relieved about from what we're seeing here.
Yeah, absolutely. I mean, even as early as Q3 of last year, you could talk to a lot of law firm managing partners and say, if you would have told me that we'd be in this situation, if you would have told me in March or April that we would be in this situation by the end of Q3, I wouldn't have believed you because it was far more positive than they had expected. And by positive, I mean, it was a lot less negative than they had expected. And now as we get into 2020, through the mid-year point of 2021, we are seeing signs that the legal market in particular has fared fairly well, that law firms were able to weather the storm and be pretty resilient through this point. Obviously, there's so much in flux right now, and nobody really knows what tomorrow, next week, next month hold. So we certainly don't want to. We certainly don't want to act like this is the start of really positive trends. But the fact that we have seen these types of numbers coming through is certainly a good thing and an encouraging sign for law firms. I think it's a point to hopefully not rest on laurels at this point, but to really try and capitalize on what we are seeing in terms of positive factors at this point to drive towards better outcomes for clients, better streamlining of processes, strategic investments in the right ways to move law firms and their practices forward, and really, in a sense, prepare for what might be next. I've spoke with a lot of firms that are saying they spent last year doing a lot of disaster response. What they want to do now is some disaster preparedness, so that if something does turn, or if the shoe falls, if the other shoe drops, they're in a better position to respond to that and to sort of absorb that and be more proactive for their own sake and for their clients should something happen again.
Well, there's certainly a lot to be encouraged here. Bill, really appreciate the detailed explanation for what came out of this year's Q2 Peer Monitor Index report.
I'm happy to do it, Lenny. Thanks for having me.
For more information, you can find out about the Q2 PMI at the Thomson Reuters Institute website.